For months, businesses have been quietly absorbing the costs of tariffs imposed by former President Donald Trump. But here's where it gets controversial. That quiet burden is starting to shift, and it could soon hit your wallet in ways you might not expect. New data suggests that rising production costs are now gaining momentum, threatening to trickle down to consumers. And this is the part most people miss: how these changes could reshape everything from grocery bills to interest rate. Producers are feeling the heat of inflation more than ever, Chris Rupke, chief economist at Forward Bonds, remarked Thursday. It's only a matter of time before those higher tariff-related expenses find their way onto the shoulders of already strained consumers. Economists had anticipated a modest 0.2% monthly increase and a 2.4% annual rise, making Thursday's numbers a stark wake-up call. But why does this matter so much? Brian Bethune, an economist at Boston College, points out that the PPI focuses solely on domestically produced goods and services, excluding imports entirely. This means the full impact of inflationary pressures tied to tariffs could actually be underestimated. In other words, what we see today might just be the tip of the iceberg. Markets reacted swiftly to the news. At the opening bell, the Dow Jones Industrial Average dropped 175 points, or roughly 0.4%. Meanwhile, the S&P 500 slid 0.35%, and the tech-heavy Nasdaq Composite fell 0.3%. However, by mid-morning, these losses had largely stabilized. Earlier this week, the Consumer Price Index, CPI, report offered some relief, showing that falling gas prices helped keep overall inflation in check for July. Yet, products sensitive to tariffs continued to climb in cost, a trend that raises concerns about affordability for households already grappling with tight budgets. This morning's sharp spike in PPI shows inflation is spreading through the economy, even if it hasn't fully reached consumers yet, said Chris Zaccarelli, Chief Investment Officer at Northlight Asset Management. Considering Tuesday's relatively mild CPI reading, this comes as an unwelcome surprise and could dampen hopes for a guaranteed interest rate cut next month. Indeed, traders quickly scaled back their bets that the Federal Reserve would slash its benchmark lending rate during its September meeting. Excluding volatile categories like food and energy, core PPI also surged by 0.9%, bringing the annual rate to 3.7%, the highest since March. While PPI tends to fluctuate more wildly than CPI, economists are paying close attention to specific sectors to understand how Trump-era tariffs are influencing supply chains and pricing dynamics. The worry with PPI is always that it foreshadows broader inflation trends, explained Tyler Schipper, an associate professor of economics at the University of St. Thomas in Minnesota. And in that sense, this wasn't a reassuring report. So what's driving these increases? More than 3/4 of the unexpected monthly jump stemmed from the services sector, particularly a staggering 4.5% leap in purchased capital equipment prices. Joe Brusuelas, chief economist at RSM US, noted in a phone interview that tariff-induced pricing pressures, initially concentrated in industrial goods, are now spilling over into the service sector. These developments suggest growing pipeline pressures for inflation, he warned. On the goods side, rising food prices played a significant role, contributing to a 0.7% monthly uptick. Raw agricultural products soared by 12.8% from June, with fresh and dry vegetables experiencing a jaw-dropping 38.9% monthly surge, the largest such increase since March 2022. To me, this clearly reflects the consequences of tariffs placed on Mexican agricultural imports, Brusuelas added. Those policies are finally catching up with us. The ripple effects of tariffs, forcing businesses to raise prices among themselves, adds another layer of complexity to the Federal Reserve's decision-making process. Bill Adams, chief economist at Comerica Bank, wrote in a note to investors that while this does weigh against the likelihood of a rate cut, hotter-than-expected inflation data may take a backseat to labor market conditions. Last month's jobs report shocked analysts, revealing just 73,000 new jobs added in July, far below expectations and downward revisions for previous months. Despite this, the unemployment rate has remained stable, partly due to fewer workers participating in the labor force. Adams highlighted immigration policy changes as a key factor reducing the foreign-born workforce, along with an accelerating exodus of older workers, retiring or leaving due to disability. We'll need to wait for the August jobs report, set for release on September 5th, to determine whether these opposing forces will tilt one way or another, he wrote. Amid all this, the Bureau of Labor Statistics, BLS, responsible for producing critical economic indicators, like the PPI, is facing turmoil. Following a disappointing July jobs report and unusually large revisions, Trump fired the BLS commissioner, baselessly alleging the data was rigged. He then nominated E.J. Antoni, an economist affiliated with the conservative Heritage Foundation, to lead the agency. Antoni sparked controversy earlier this week when reports surfaced suggesting he considered suspending the monthly jobs report to tweak its methodology. Though Stephen Moore, another Heritage Foundation economist, assured CNN that Antoni plans to continue publishing the data if confirmed, skepticism remains. Adding to the challenges, the BLS is grappling with resource constraints under the Trump administration. Budget cuts have forced the agency to reduce collections in its CPI reports and discontinue calculating 350 indices, starting with July's PPI. Scott Sager, a spokesperson for the PPI and BLS, stated via email that the discontinued indexes represent less than 1% of the PPI and will minimally affect accuracy. Nevertheless, experts argue that cutting corners in statistical reporting jeopardizes our ability to make informed economic decisions. Economists, statisticians, and former BLS commissioners are urging Congress to provide greater, not diminished, funding for U.S. statistical agencies. As debates rage on about the reliability of economic data, one thing is clear: the stakes couldn't be higher. So do you think the current administration's approach to economic statistics is helping or hurting transparency? Share your thoughts in the comments below.